there, it's entering an area of supply. I'm more likely than not going to pull the trigger and take the play. So the first thing that I want to show you is this Wednesday play. So right here off the bat, there are a couple of things that I noticed. The first thing is we have a bullish engulfing. The second thing that I noticed is right around the zone of 432.92, we went ahead and tested an area of support that at one point was an area of resistance until the breakout happened. So in a case like this, what I normally will do is I'll go ahead and box this zone right here, as this is the candle that initiated that breakout. That right there, I'm going to identify that happened on a Tuesday going into a Wednesday. If price returns into that zone that we saw on Tuesday and we fail to break below and start to push up, in other words, the buyers are stepping in, then that's already giving me a clue to what potentially is going to happen. The second thing that I'm going to look for, of course, is confirmation. I don't want to just blindly enter the play. Are we getting any strength behind that push to the upside? Well, in this case, we start having a pretty decent candle. That gives me some more confidence that I should potentially take this play. Now, in this particular instance, the other thing that I'm seeing is we have what looks to be a falling wedge off the bat. I don't even have to draw these things anymore. I'm just drawing it for you guys. The more you do this, the more you're going to get used to seeing these patterns. But right off the bat, boom, it's there. And the way you identify that is as price is trying to push up and fails, it's expanding. But as price slowly starts to trickle down, it's contracting. So when you see that setup, what's happening is the market makers are kind of giving you this false hope that we're going to have this massive drop off. But what they're really trying to do is to cautiously bring price down slowly to a level that at one point it broke out from, this being Tuesday. At least this is what I believe. Once that happens, well, think about it like playing poker, right? You're playing a bluff. They're bluffing us and making us believe that we're going down. We're going to continue going down. That's the hope. All the while, these guys are ready to load up on cheap contracts on the call side. Look at it the last couple of days. There was a lot of out-of-the-money contracts that were going for $17, $20. I think Rags at one point called out a play for $21 or something, and it went 400%. Well, this is exactly what they do. Remember, you don't want to buy high and then, sell at a loss. What they're trying to do is buy at a discounted rate and then sell at a high. So this is exactly what they're doing. They're going into a setup where they can go ahead and push price down to a reasonable level that they find acceptable to purchase a contract at a very reduced cost. All the while, they liquidated all the people here believing that we're going to find more continuation to the downside, and that didn't happen. And then they reversed the markets and they go ahead and buy the cheap call contracts and then push the price up. Now, people sometimes ask, well, where's price going to go? How do I know where I'm going to potentially take profits? Very simple. The way I look at it is for every candle that is formed, it should go higher than the previous candle. So if we look at here, each candle that is forming has gone above the previous candle. That's a continuation play. By default, you already know that if the next candle over is pushing higher than the previous candle, then the continuation is still there. That's one way to look at it. The second thing you can do, which I rarely do, but I do use it, I'll use my 9 moving average, and I'll also use VWAP. These are the only 2 indicators that I'll ever use. So if you don't feel confident in getting into the play right off the bat, the thing you can do is, as long as price is hugging and holding above that moving average, the 9, and then crosses over to the VWAP, which is a very institutional type of indicator where the buyers will step up and start pushing price even more aggressively higher, which they did, then this is a very strong indication that the move is still on the uptrend and there is no reason to sell. Now, we do have two candles here. And at one point, they were struggling to go up, and that could give you some type of false, fear in terms of, wow, I might not be getting any more of a movement to the upside. But you have to kind of control your emotions on what you start to feel versus what the market's telling you. Remember, each candle has a language that is trying to communicate to you. What I mean by that, in this case, in this instance, these two candles are indecision candles. Neither the bears or the bulls are winning, kind of like a pause in the market. The second thing that I notice in these particular candles, beyond being indecision candles or doji candles, is that they're still above the previous candles. They're neither high or low. It's kind of a neutral zone, kind of like almost an inside candle. So it wouldn't give me any indication to sell. On the contrary, I'm going to hold. But a lot of new traders, when they start to see something like this, they start to build fear and doubt in their heads, and they'll get out of the play. It happened to me when I first started. But the more you do this, you start to understand and how to react to particular candles because they're communicating a certain language to you. They're either telling you that the buy is still strong or the buy is starting to get weak and you need to get out. And the other way you can understand that is, particular here, at some point in time, once we broke out, there was a moment where there was fatigue and the candles were very small and they weren't very aggressive. The way I look at this is two ways. Either one, the buyers are starting to get exhausted and the potential for it to fail is there. Or two, it's set up by the market makers to give retails kind of like no clue at all what potentially is going to happen. But what in reality might happen is it's a moment of consolidation. Think about it like a Coke bottle that you shake it up and it starts to build up a lot of pressure. And then when you take off the cap, it pops. Well, in this instance, it wasn't that the buyers were losing strength. They were collectively building into that momentum that we got previously around here. And once they had enough momentum, enough orders in the backlog ready to execute, boom, we just take off and broke out. So these are the things, these are the cues that the markets are giving you for you to make that kind of right decision. It's not always going to be perfect, but the more you do this, the better you'll get at it. And hopefully you'll be more in tune to what you should be seeing, how you should be entering, and the why. Now I'm going to take a pause right here and open up the floor for any questions that you may have. If anybody has a question, they can unmute their mic, ask. If not, then I'll continue with the lesson. Okay, so nobody has any questions. Cool. So the next play that I took in terms of SPY, right around, let me see, boom, boom, boom. Give me 1 second, guys. Here, there's another play that I took around here. And this one was massive and very simple. Granted, I didn't take it all the way down, but still in all, it was a solid play for me and hopefully for you guys as well. Again, these are things that I already see. I don't really have to identify, but we're getting a channel, and that channel is reaching a level that particularly has shown a level of resistance. Once we start to see that level of resistance, what do I identify to tell me that potentially the market's going to reverse and no longer have the strength to go up? Again, understanding your candles right here. If anybody knows their candles, then they would already automatically identify this as a hanging man. Right there, that little candle that looks kind of like a T. That hanging man indicates that more likely than not, there's going to be a reversal happening. Now, I do want to point out that the lower the time frame is, the higher probability that the candles will give you false signals. So keep that in mind. But the higher the time frame, the more likely that the candle that you see in a particular setup will execute and play out. So when I saw that in relation to the rising channel, I felt very confident that this could potentially be a downside play. And sure enough, that's what we got. We got a beautiful setup all the way to the downside. Now, how did I know that it was going to go back to maybe 433, 432? Very simple. Going back to supply and demand. This happened on Wednesday. Where did the price start to take off? Well, exactly where it took off on Wednesday. That's exactly where I drew my zone, that more likely than not, that's where they were going to drive the price. And if it had any possibility of holding, that it was going to be around that zone. In this case, they went ahead and pushed it even further down. But that was the zone that I had specifically pointed out to myself, that that was the farthest that it could potentially go, unless it couldn't hold. And then, of course, it could go down further, which it ultimately ended up doing. Now, going into 430, 431, same thing, supply and demand. If we go back here and we look at these candles, well, this is the candle that initiated, these candles right here initiated a push to the upside until it finally popped up to the next level over. So again, when you see this area of consolidation where candles are kind of bunched up together that are trying to push up or down, that to me identifies a level of supply or demand where the market makers are going to try to drive the price either up or down. And sure enough, that's what they did. They didn't hold on the level of 432. They went ahead and pushed it to 430.31. And then once it got there, they didn't push price further down anymore. What they did was they just now bought it up, popped it up, and we got to retest around 434. Now, a couple of days prior, when I took this play to the upside, I actually said that more likely than not, I think we have potential to either go around 437 to 439-ish, if I'm not mistaken, and 438. How did I know that? Well, let me go into the 1-day time frame. Your gaps are always going to be a telltale sign of where potential price is going to go. So right here off the bat, if we look at this box, boom, that's a gap. What happened? Price was driven that high. Why did I give you a range between around maybe 439-ish or 437? Because previously, again, here we had a strong buy up that pushed off this 437. Here we had this gap that was sandwiched between 436 and almost 439. And that's why I knew that potentially when we had that run up, that was where price could potentially go. And that's exactly what happened. It's never going to be precise. Always think about your zones and your supply as a proximity. It's never going to be black and white to the T. Sometimes you'll nail it, sometimes you won't. But what matters is that you have a range to shoot for when you're in a position on where potentially price is going to be driven up or down and where to take your profits. Now let's go to AMD. AMD, 1 hour. Let me get rid of these lines. Get rid of the VWAP. And this is something that my brother Boyce taught me very long ago. Very simple setup, beautiful. I saw it, and there was also some market weakness based on SPY and other indicators. So I said, you know what, this is like something that I would want to take and see if it plays out. Buying some time. Of course, I called out next week's contracts 108. First thing I saw off the bat is you have price trying to drive up. But if you guys either use the stochastics, which is the indicator on the top bottom, or the RSI, which is the lower bottom, what it shows is that in actuality, buyers are starting to get weak and it's starting to fall. Now, the way you want to do this is you want to make sure it lines up pretty close to where the price is on the upper side of where the candles are forming. But if you look at it, price is trying to push up but failing, and the RSI is starting to show some weakness in the push up and starting to drop. So that was the first thing I noticed. The second thing I noticed, and this is going back to your candle formation, is a potential shooting star. Well, if you look at this, it looks like an inverse hammer right here, or a shooting star. We had a rejection a little bit above that 110 zone. That's telling me that the sellers are there. They're not trying to get price to go any higher. And then, of course, I want to wait for a little bit of confirmation, which once we got into this candle, which is a doji or a spinning top, it's telling me that there is some indecision, but still that the sellers are present and they're trying to fight that battle to keep the price down. That's exactly where I started to call it out. At one point, we were down 11%. We got another doji, but it going again into what I've explained on SPY. Where is this next candle form? Even though it's a doji, look at where price opens and closes. It closes lower than the previous candle. That means that the buyers are starting to, the sellers are starting to gain some momentum in trying to reverse it from going higher. And sure enough, the next candle spelled doom for AMD. We got this nice fat candle to the downside. I sold right around here for like 25%. I know some people showed me 28%. And then we had a little bit more of continuation to the downside where we got as low as 107.50 or 107.50. I gave everybody a heads up that we were reaching a zone of support and that if you were still holding your contracts, just to be careful because potentially it can reverse. And sure enough, what happened? Did get that pop to the downside right here. But again, if history wants to repeat itself on where the initial push up a couple of days ago happened, then this would have been the prime zone for the market makers to try to do that, which they did and failed. But at one point, it did have a nice little pop up. And the reason, again, supply and demand. If I get this box right here, box it out, where initially it broke out, what happens? Well, guess what? We enter the zone of demand where buyers previously were a couple of days ago and purchased it. And that's exactly what happened. My methodology is not complex. It's very simple. It's being a student of the candles, understanding what dynamics they represent and what specific time frame. Again, the higher the time frame is, the more confirmation you're going to get on the type of candle that is playing out and whether or not it's going to execute what it represents. The second thing that I always look for is zones of demand and supply, because these are zones that have previously shown that the market makers are going to retrace price back into or out of. And lastly, the support and the resistance, that is it for my kind of setups and what I look for. And then lastly, of course, patterns. I'm a pattern type of person. A lot of people say patterns don't work, but I've proven time and time again that the patterns do work. But of course, like anything, they're not going to be 100%. And if you're doing it on a lower time frame, the likelihood of those patterns failing will happen. But if you see it on a higher time frame, the likelihood of those patterns playing out is there. Again, does anybody have any questions, concerns, doubts on what I'm sharing? If you do, let me know.
When you're doing your technical analysis, what time frames do you look at first? Is it the long monthly time frame or the daily?
Technical analysis is based on what you're trying to do. It's a good question. You have to ask yourself before you enter the market, what am I prepared to do? It's a tool, and that tool is going to be used specifically depending on what you're deciding to do for that day. Like today, I mainly scalped. So in that instance, going back to SPY, since I understood I was going to scalp, I'm not really looking at the 1 hour time frame. The main time frame that I look at is the 30-minute, which is it gives you a pretty solid, clear picture, I think, in my in my own regard, I think it's one of the clear ways to see the market structure and have a good setup where the patterns are going to play out like you see right now. The lines that I use to get the falling wedge, the rising channel, they fall in line perfectly. So it's very good 30 minutes. If not, the 15 minutes would be the next one. And then from there, I will drop down to either the 5 minute to either trade a scalp, or I'll drop down to the 2 minute. I don't recommend this for anybody that's still starting out. The candles will move very aggressively. You're going to see more wick action. You're going to see a lot more candles mixing with the greens and the reds. And if you're not used to that, it's going to fake you out and get you nervous. But to give you a good idea of how I would approach this on a lower time frame when I'm scalping, let's say we went ahead and broke out like we did right here. How do I know to continue this play and not freak out? Again, going back to patterns. What patterns do I see? They're not going to be the way you see them in textbooks. The textbooks are going to give it to you nice and clean and beautiful. You have to kind of see in an abstract way whether or not these patterns are playing out. So the first thing that I see as the continuation play is happening is, let's say you missed this, and I call this out for the downside. You missed all this right here. And you're going, well, I don't want to chase. We already had a very aggressive move to the downside. I don't think I should get into this anymore. And in retrospect, I would say I agree. But if you understand what you should be identifying and seeing, then there is still opportunity in the markets to go to the downside. And I'll show you right now. If I would have missed this whole call out right here, well, guess what? What pattern do I see off the bat? I see a bear flag right here. Off the bat, there's a bear flag. And very simple way to identify a bear flag is it's a combination of candles that are ranging within the same context. They're neither high or low. They're kind of staying within that same range. And that starts to create a kind of an angle or kind of a rising channel, if you want to take it that way. And that creates the bear flag. So that's the first thing I identify off the bat. The second thing is, where would my stop loss be? My stop loss for this would be automatically, because I know, and I've seen it multiple times, right around the close of here. So I would hold this out up to right there, just because I've seen candles break out and you think, oh, it's reversing. Yes, we're going to go to the upside. And then boom, it continues down again. They liquidate you. They get you trapped into a call, and then the continuation place happens back to the downside. So as long as price stays below the open of that 434.34, I'm good. I'm going to hold. And as long as this pattern holds, which it did, I'm going to get me into some puts. And that would have been the second opportunity right there. But now let's say you missed that opportunity. You go, well, I missed that opportunity, Mex. Where the heck can I get into again? Because everybody's telling me that price is overextended. We're going to see a reversal. And sure enough, again, where the market makers are going to get you right here, well, this kind of looks like a hammer. It aggressively pushed up. We got the wick. That's what it's supposed to represent. And then we got the push up, and then we get the next candle. But guess what? The next candle showed no strength. That already is like a telltale sign that most likely this is a little liquidity grab to the continue downward. And secondly, again, if we look at the pattern, how it's forming, this is another bear flag. Boom. There's another bear flag. So if you missed the first setup, you missed the second setup. As long as this stays true to what I'm seeing, and maybe my stop loss here is going to be at the high or midpoint of these wicks right here around 433.27, I'm a player to the downside still. And that would have been your third opportunity. And boom, that's it. And that's how you would have taken that play. But to answer your question, I would have used either the 30-minute or the 15 minutes for my setups to go into my lower time frames for my scalps. I want to see some good, solid structure. That's so important because the thing is, what happens with a lot of people, and I've learned to kind of tone it down, and I'll call out some right off the bat at 9:30, but for the most part, if you've noticed, I usually start calling things out around 10, 10:30, 11, 11:30, or 2 o'clock. Why is that? And I think a couple of days ago I mentioned it. I said, "Do you guys want some sauce? Do you guys want some information?" That I found to be very true. Market structure and the real move initially, for the most part, has always happened between 9:45 to 10:30. And the next move usually happens between 11 to 12. Those first 15 minutes, for the most part, is pure noise that gets a lot of people trapped in a certain position and then they get liquidated. You want to have solid market structure. Now, the last play for the day, I didn't take it myself, but again, this is going back to what you should be seeing and identifying is right here. Look at this. This is consolidation. When you start seeing candles stacking up side by side, it's neither going up or down. This is something. This is going to give me like an alert to say, hey, I need to pay attention to this. They're building into something. Is it going to be to the downside? Is it going to be to the upside? I don't know yet. But let me pay attention to that. Well, sure enough, what do once they have this sectioned off and consolidating and having every candle just build onto each other? They went ahead and popped it to the upside. And how do you know to enter this position after this massive downside run? Well, now we want to look at volume. Is the volume strong? Well, compared to previous volume, hell yeah, it is. Look at that. Look how strong that volume is. So we get confirmation there that the strength in the volume is there. And then we get a second confirmation of this very strong breakout, followed with continuation of another solid candle. If I see two continuously solid candles like that with increased volume coming out of consolidation all day long, I'm willing to risk taking a play to the upside. And where would my stop loss be? Well, my stop loss will probably be, if I got in on the first candle, probably right at the bottom of here. If we break out here and continue downward, then I need to get out. But for the most part, I'll probably be risking almost half a dollar or 75 cents and willing to take a shot that we're going to push up. But that's how I would scalp. So my tools for that would be for scalping. If I'm going to use a higher time frame like the daily, and let's go back to let me see what ticker did I see a while back. I think Disney, if I'm not mistaken. They broke out already, but Disney right here, boom. Disney had a nice breakout. This was Thursday the 12th. And then we have this nice push going into it. So if I was looking at this, oh, this is a 2 minute. Sorry about that. Right there. Disney. I know it had a breakout. There we go. Yeah, that's exactly what I was looking at. So I already had this trend line. So Disney, a couple of days ago, I saw this trend line and I didn't take it, and I hate myself for not taking it because it's been beat up so much that psychologically I said I don't think Disney has it in it to push up. So a couple of days ago, I drew this trend line, and I was watching it, and I said to myself, you know what? If Disney can hold 79.50 or 79.33, this would be a nice swing. And there's a couple of reasons why I like this setup. First, we have this kind of gap right here between this price action. And guess where they took the price? Right into that gap. The second thing that I saw was that, again, going into price action, supply and demand. Boom, this is exactly where price stopped. And I said to myself, if we can get a breakout of $81, this could have a nice little pop. And sure enough, it did. And I missed it. I doubt it myself just because of how weak Disney's been as of late, and also what's going on in Hollywood with the strikes. So I didn't take it, but it did exactly what the charts were showing you. So sometimes even myself, I see a beautiful setup that was great for a swing and I didn't call it out and I didn't take it, even though I charted it, because I doubted myself and I let the stuff inside my head tell me don't take it. But this would have been a nice risk to reward because everything was there. We had the gap to the upside. Price was returned into a zone of demand that had previously popped from, and it was breaking out of a triangle pattern. So that downtrend finally broke out, and it was pretty aggressive, that breakout. So this would have been the kind of chart that I would have been looking for. And in my tool sets, I would have gone into this not for a scalp, not for a day trade, but potentially for a setup for a swing. Because I think, if I'm not mistaken, yep, this was around the time when this is starting to slow down right here. Yep, Wednesday, October the 4th, and then this started to push up on Thursday the 5th. So yeah, this would have been a beautiful, beautiful play to the upside and hold out for like a week or so. And unfortunately, I didn't do that. So that's how I would have approached it. Now, if I was looking at something on a higher time frame for longer, then I'm going to definitely go into like my weekly or my monthly. And then depending on what I see here, I'm potentially going to decide to swing these for a couple of weeks, maybe a couple of months. Now, those are leaps, but not going to day trade, not going to scalp, because the setup is different. The information that I'm seeing based on a higher time frame is telling me, hey, this has time to reverse, and we're going to potentially reverse. Well, A, B, and C is telling me that this much room it has, a $2-3 move to go still to the upside, then I'm going to go ahead and take that. And then I'm going to buy longer dated contracts. Here you can go a little bit out of the money. You don't have to get in the money or at the money for swings, because you have time for that momentum to build and potentially gain traction to where it hits your strike price. Now, for me, what I've been lately doing, not to change topics from what you were asking, but let's say if I'm trading SPY, especially SPY on ODTs, the one thing that I've been doing as of late, I get either at the money or in the money if I'm scalping. And the reason being is that theta is going to be that much greater, and it's going to beat delta. And when that happens, if you get a slight pullback or we're in a chop, it's going to destroy your contracts very quickly. But if you get at the money or in the money, delta is strong enough to kind of hold theta off, where you don't see the effects of that much compared to somebody that's buying really out of the money. Unless you nail it, like let's say in this position right here, and you get a really cheap out of the money contract and you nail it, it's not going down anymore, and it just starts to pop up to the upside, then you're good. But if you get in and at the best entry, then I myself have noticed that ideally getting at the money or in the money contracts is so much better to fight off theta when you're especially trading ODT, if you like to do XPX or SPY. But if you're doing really out of the money, you get a bad fill or you get a bad entry and you're in a chop somewhere, then you're going to see your contracts get beat up really quick. So I recommend anybody that's trying to do ODT to probably do at the money or in the money. It's going to cost you a little bit more, but it's going to save you in the long run when you get caught up in a chop zone, or you don't get the best entry initially, because since you're so close to the strike price, once it hits your strike, then theta starts to wane and delta starts to build more strength, and then you start seeing those dollars come in that much faster, which is very important that you guys also understand your Greeks. But yeah, man, that's how I would approach trading with the different time frames. Depending on what I'm deciding to do for that day, am I a scalper? Then I look at my lower time frames, 30 minutes, 15 minutes, and then I'll drop down to the 5 or the 2 to trade at. If I'm a day trader, like I did with AMD, then I'll look at the 1 hour, see the market structure on the 1 hour, get a weekly contract or next week contract, and then play it out, because I'm going to hold it for the remainder of the day. And then if I'm going to swing, then I'm going to look at my 4 hour on one day, or possibly the week chart, and then probably get 2 or 3 weeks out, a little bit out of the money, and give myself some time for the play that I'm seeing on a higher time frame to flesh out. Hope that helps. And hopefully that answers your question.
It did. Appreciate it. Thank you.
Not a problem. Anybody else? Anybody have questions on the supply and demand, the consolidation, candle formations, what you should be looking for, what they represent? Let me know. Nobody? All right. Well, guys, that's it for me. Hopefully this class was helpful for some of you that may have some challenges identifying supply and demand, market structure, patterns, and what you should be looking at when you look at patterns, candlestick formations, and what areas they represent the best entries and exits. And if you have no further questions, then that is me
I have a question, if you don't mind.
Yeah.
Now, the formations for the candlesticks, what are the most common ones that you often see or that it catches your eye really on time frame of maybe 1 day or a weekly?
Let me get to a different chart. Let me go to Qs. Let me go to the 1 day. Okay, so the first thing that I noticed off the bat, and this zone right here, and this is just my interpretation. Again, what I see and how I see it doesn't mean that I'm 100% right, but how I interpret the way I see things. You have two previous candles, 1 day prior, and then the following candle that has the move to the upside. The wicks, you guys got to understand your wicks. When you see a wick on a daily where it aggressively rejects going down lower, that automatically tells me that the buyers are there. Again, if I can use an analogy of like playing poker, they're not going to show their hands right away. The market makers are there to psychologically fuck you and make you doubt yourself on what you're supposed to enter, either the upside or the downside. They're not going to show their cards right away. But if you understand the language of the candles, then you start to kind of unravel what they're potentially setting themselves up to do. So in this instance, these are 1 day candles. This happened this happened a couple of months ago, but on May 20th, we had this very strong drop, and then we had a strong push back to the upside, creating this hammer. We had a small little pop, then a drop again. But following a couple of days later, 4 days later on Tuesday, we pretty much had the same setup that we saw a couple of days ago. Again, that's telling me the market makers are there. They want this level. They're just not ready to execute it, but they want this level. So once I see this pattern repeat itself, as they did in Friday, we're going into Tuesday, I'm more likely than not willing to take a risk on calls to the upside. And this would be something that potentially I would swing and hold for a couple of days if I'm basing my decision on the daily time frame to be a day trader. And then to day trade, excuse me. And then based on that, well, guess what happens? The market makers finally show their hands and boom, they take the price all the way as high as 313. This is back in 2022, of course. This is like a year ago, guys. So it's not current. But another thing that you can see here in market structure, if we look at the daily, again, going back into that consolidation kind of thing that I showed you previously on a lower time frame for a scalp on SPY. Well, kind of the same setup here. We really don't have price going up. We really don't have price going down. It's kind of just stacking one after the other within a range. So how do you trade this? Well, once price breaks out of this box, either to the upside or the downside, then I'm a player. In this case, it broke out to the downside. Once I get that confirmation to the downside from this consolidation that was happening for a couple of days, I'm going to position myself into puts. Another thing that I want to also emphasize, if you guys don't know this, when price jumps a certain level, as we see here, and as we see here, that's usually a continuation play. That means that when that happens, that the move is so aggressive that they've negated a couple of levels and they're pretty much just cutting in line to the next one over. So when you usually see a candle that pretty much jumps to $3 and negates the previous level, the continuation will potentially still happen and continue downward or upward, in this case, downward. That's exactly what we saw. So when you see that pop to the upside and then there's a gap between it, then that's usually a signal that's going to continue. And also, it's also a signal that at one point in time, these gaps will later be filled. Like if we see here, gap gets filled there, and then later down the line, this gap here gets filled right here. But that's how I would interpret those two setups. Another one, let's say a little bit more accurate and current. Let me see. All right, here. We saw this kind of pattern on the daily. And once we see patterns like this, it's kind of telling me it could potentially go up or it can go down. It's kind of a neutral type pattern. I wait for the break either to the upside or the downside. And then depending on the candles I see, in this case, I see kind of like these two candles that are almost bullish, but also kind of bearish, because in the terms that they're not really aggressive to the upside, they're not really aggressive to the downside, kind of more like an indecision happening there. Then more likely than not, I'm going to be interested in taking this position to the downside. And once I get this bearish engulfing, which we see here, then no brainer, I need to take a position to the downside. And sure enough, once we get this bearish engulfing, what happens next? Again, we get a very aggressive push to the downside and continue down until otherwise the price can't go any further down. And then we start to see reversal. And in this case, what we see here, again, going into candle recognition, this is a dragonfly. The dragonfly is like a lowercase t. And when you see that, it's in the doji family, but it's also a reversal candle. Once you see something like this on a higher time frame after an aggressive move, the way we saw it, this candle is going to get me interested. Again, what does the wick tell you? Well, if we form a wick the way we did in this particular instance, telling me that the sellers no longer had control, the buyers stepped in and they said, hey, we're not taking this price any lower. We like the price around 353 or 352. We want to start pushing it up. The second thing that I'm going to understand is within the context of this doji family branch, this is one of the more aggressive ones that initiate a reversal called the dragonfly, where we have a long wick on the bottom, short wick on the top, and then the little body in the middle higher up, which indicates like an abstract dragonfly. Well, this again indicates a potential reversal to the upside. So this would be, for me, on a daily, a potential play for calls where I'm willing either to day trade it or swing it for a couple of days and try my luck at it. Because again, you're in the market of probabilities, not guaranteed. So I would have done that, bought a contract for a couple of days or a week, and see where it took me. In this instance, it had a nice little pop until it failed. After that, right now, we have an indecision candle right here. We have a spinning top. That means indecision again, guys. This is as of today. We'll find out tomorrow whether the market wants to go up or down. But keep in mind that this candle is stating that neither the bears or the bulls have control. So it's 50-50. But if price stays below 337 and we can break below 370, I think we'll see a dump. But if we break above 372, I think we'll retest 375. That's how I would interpret this candle. It's an indecision candle. That means that neither side has taken full control yet, but we are reaching a level of resistance, which is right above the 372. If we fail to break above that, then more likelihood of it regressing back to a lower price point that would get buyers interested is higher. And then maybe after that, we'll see another attempt to the high side. But then we also have all this area where we could potentially drop back down to and play it out. And then once they get it down to a very low level, then you see the market makers say, okay, price is cheap enough. Let's drive price back up again. Because again, the name of this game is to buy low, sell high, not the other way around where you buy high and you sell at a loss. So those are the things you want to keep in mind and what I identify in terms of candles that I like. I like the dragonfly. I definitely like the bullish and bearish engulfings. And the spinning tops like these that I just pointed out, that tells me that there's indecision that I need to pay attention to, that I cannot be biased, even though we're still up, because that is telling me that both sides are struggling. So these are the things that I pay attention to more often than not what I'm looking at, But your hammers, your inverse hammers, your bearish engulfings, bullish engulfings, those are the ones I mostly always look for and play out on every time frame. They usually play out, but when you go into a lower time frame, what you want to definitely look at and pay attention to is the volume there. Because if you see a bullish engulfing, let me go into a lower time frame and see if I can catch one. Like, for example, okay, beautiful example. This is exactly what I want to talk about. This is a liquidation move. So this is something you guys got to pay attention to. You guys, I'm not saying everybody, but it's happened to me. I know that much. So I'll just say it in context to me. I get excited. I see this very aggressive candle, and I'll say, "Oh shit, got a very aggressive candle. It definitely has more strength and body than the previous candles, and the volume is there." And I automatically say, "Fuck it, I'm buying some calls." Guess what happens? I get liquidated. Why? Because when does this happen? Let me see. Let me get this out of the way. Let me get that out. This happens right at 9:30. That's why I say stay away from fucking 9:30. So this happens exactly at 9:30 on the 5 minute. My dumbass would probably take this because I would say we got a lot of volume. We have a beautiful candle that's solid. And I did not patiently wait for confirmation from the next candle to confirm there's continuation. And look at the volume of the next candle. But where's that body? There is no body. What do we get? We get an inverse hammer or shooting star. And what happens next? They liquidate everybody like my dumbass that I would have gotten here at 9:30 and liquidate everybody at around 9:35 to the downside. Now remember what I said, that the real structure happens around 10ish. Well, guess what? We get consolidation here. I don't make this stuff up. I'm doing this out of learning from my mistakes. Once they liquidate everybody here, we have a nice downside move. And then once we start approaching 10, 10, 15, price can go further down. We start consolidating to the side, and then we pop back up and try to break out where we previously tried to break out from. But again, patterns are not going to be perfect. But when I look at this, what do I see? An M pattern. They're not going to be like textbook. So when you see that more likely than not, what they wanted to do was drive price down once, get it at a cheap cost, then drive price back up, get it at a cheap cost for the puts, and drive price back down. And then the rest is history. It breaks down past that previous support that it couldn't break before. And that's how I would interpret that. And that's how I would see it. That's why this is a perfect example that even though we had the volume and we had a very beautiful candle here, we always want to wait for confirmation on the next candle that there's follow through. And there was no follow through. And what we saw here was a shooting star, failure to break resistance. Now we're around 9:35. And then the real move happens to the downside. And the last thing that I want to show you now that I remember is opening print. This is what I, always preach about. What is opening print? Well, the opening print indicates whether we're going to move up or down. Kind of like the OBR, the open ORB, open range break. So pretty much the same setup as the open range break. What you want to do is you want to wait for either break to the downside or the upside. So knowing that this 9:30 candle establishes our high point, we want confirmation that the next candle is going to break, hold, and continue. If that happens, I'm a player to the upside. If it fails, then I'm a player to the downside. That is very simple. Your opening print candle sets the stage on whether or not we initially have a move to the upside or have a move to the downside. And it also lays out the groundwork where price will be returning to once it drops. So what happened after 10 o'clock, right around here, midpoint 10:30, market makers drive the price back up here and then drive the price back down. As simple as that. There's no complications. If you can pay attention to those simple rules, I promise you'll make more money. You'll have better entry. Sorry, does anybody have a question? Going once, Going twice. Okay, this is another one. One more time, and then I'm out, guys. So the same thing happened here. What happens here? This is a tighter spot. Again, consolidation move. So I'm going to box this out right now. And this is the 5-minute on the cues. And I'm going to go down to the 2-minute. So right here is 9:30. Like, 9:36, 9:34, 9:32, and okay, here's 9:30. So what happens again? Initially, we get the same thing that happened in the previous day. A strong sell volume, unable to sell. But then we get a buy order to push price up, and everybody gets excited, like, oh shit, we got a very strong candle at 9:34. Let's get into some calls. This thing's reversing. Well, the first thing you have to understand is we're in a range, which is not the ideal way to trade. Second, volume is weak. Third, do we get confirmation, as we did in the previous example that I give you, of it breaking out of this resistance and this range? Neither of those things happen. That's why you have to be patient. Wait on your hands. Hold. You're supposed to be a sniper, not a machine gun. When you're trading, it's not about how many trades you take or how quickly you can get into a trade. It's about seeing the right setup presented that confirms everything you need to within your rules and guidelines to say this is a good setup. This is worth risking my money for a probability of making some money. Not just because the market's open, not just because I saw one or two candles move in a certain direction. No, I need the confirmations. Well, the confirmations weren't there. So we had this failure to the downside. Market makers fool you and give you this aggressive candle. Textbook says we see an aggressive candle like this that's pretty much engulfing the previous. We should take this move, but the weakness of the volume and the failure for continuation and the follow through would give me a red flag that I do not need to take this trade. So what happens next? Well, around 9:35-ish, 9:36, the real first initial move happens to the downside. So they take it from 372 all the way to 371, not a big move. And then right again, what happens? Around 10 o'clock, can't make this shit up. Once it consolidates here, can't go further down, pop. And this was a real move. This was a real move. This one was a okay move if you wanted to scalp it, but this was a real move. Once it held here, couldn't go further down, consolidates, breaks through this initial fail that it had a couple pre-market, market open, and we get that real nice aggressive pop to the upside. So this right here around 10 o'clock almost was the real move that would have made you way more money than taking this risk. The risk to reward here wasn't the greatest, but if you were doing a scalp, you understood that and you were in and out at the money or in the money, you made a nice couple of dollars for a warm-up play. But the real move happened right around 10 o'clock. And the risk to reward here was much greater. So hopefully those examples on the open range also break helps and what you should be identifying in terms of the candles that you're seeing with the volume in context to those. Does that answer your question? All right, guys, if nobody else has any more questions, I hope this class helps some of you see what I see and identify the things you need to be identifying to make better entries, exits, and decisions in the markets. I'm Metric, I'm out, and I'm happy to have you guys here in the Wealth on Mars educational live class. I'm out. Have a great night.